Hello, this is Andrew Westhof with Homes Mortgage Lending, and today I want to give you an explanation on how the 2-1 buydown works. So you may have heard that term from other lenders, from real estate agents, and not sure exactly what the heck that means or how the program works. So I'm going to give you some in-depth detail on what that works with an example today. Now, one caveat is that not every lender does this exactly the same way. So I'm going to show you how Homes Mortgage Lending does it, and most lenders do it the same way that I do it, but there are some variations out there. So if you are working with a different lender, then certainly touch base with them to see how their 2-1 buydown works. And I am licensed anywhere in the state of Michigan, so if you are looking for a lender that offers the 2-1 buydown, all my contact information is in the video notes. Feel free to reach out to me. I'd be happy to help. So the 2-1 buydown, the way that it works is you lock your interest rate in when you buy the home today, when you have your offer accepted. And the first year, the rate is 2% lower than what you lock in. And then the second year, it's 1% lower than what the rate you locked in. And then it goes to the normal rate. So I'll show you with an example to show you in black and white to give you a little bit more clarity. So say you buy a home for $250,000 with 20% down today. That would be a $200,000 loan amount. Assume today's par interest rate, the rate that doesn't have any points, is 7.25%. That's what you lock in at. For the first year, you would have 2% lower, so 5.25% rate for the first 12 months. And then the second year, months 13 through 24, you would have a rate of 6.25%. And then after year 3 through year 30, the rest of the loan term, the rate would be 7.25%, assuming you did a 30-year fixed loan. Now, so part of the thought on this is that you're probably going to be refinancing before those 2 years is up, because we do anticipate rates are going to come down. There's no guarantee, so you want to make sure that if you're doing this, that you're comfortable with the payment after it adjusts in year 3. However, likely you'll be refinancing before that term is up, so you're just kind of getting the lower interest rate from the start as opposed to once you refinance. Now, the cost for this interest rate buydown, there is a cost to it. It does need to be paid by the seller, so you have to work with your real estate agent as well as your loan officer, because you're going to need to negotiate when you make the offer for the seller to pay the closing cost for this. And I'll show you exactly how that works. So for year 1, that difference on the payment at 5.25% is $259.94. So a really good rate reduction. The first year, you're saving almost $260 a month. And then year 2, it's $132.92 less than the 7.25 cents. So you're saving a good chunk of change. What we do is we total that amount. So 12 months times $259.94 for the first year, $132.92 times 12 months for the second year gets us $4,714.32. That's the amount that we need to ask the sellers to pay in seller concessions to cover the 2-1 buydown. So it's not like it's money that's, we're not like actually lowering your interest rate. We're just putting this money in an escrow account with the seller's funds so that they're paying to reduce your interest rate over the first 24 months. Now, as I mentioned, you're probably going to be refinancing over in the first 2 years. Hopefully rates come down, and they likely will. So what happens with that money is it's sitting in an escrow account every single month when you make your payment. The first year, $259.94 comes out of the escrow account for each payment, and you pay the difference. And then the second year, the $132.92 comes out of the escrow account every time you make a payment, and you pay the difference to get to those interest rates, that 5.25 and that 6.25. So if you refinance before that 24-month period is up, all the money that's left in the escrow account, every single dollar is going to be applied to the payoff of your current mortgage. So it's going to be money netted out of your loan. It's going to be like bonus money that you get towards your paying down your loan or closing costs on the refinance, however you want to apply it. So it's not lost money in any way. There's not like, oh, shoot, I don't want to do this program because if rates come down 6 months from now and I refinance, I'm going to lose all that money that I negotiated the seller to pay. That's not how it works. So if you have any questions on this, please leave them in the video notes. If this was helpful, please hit the like button. And like I mentioned, all my contact information is in the video notes. So if you're in Michigan and you want to talk more about this or anything to do with a home purchase in Michigan, I'd be happy to help. I hope this was useful and made sense. And I hope you have a wonderful day. Thank you.